Good morning, everyone, and thank you for joining us today. My name is Razi Christians, and I'm the National Sales Manager at PPS Investments. Today, we are joined by the Capital Group, who are one of the largest asset managers in the world, and they've been around since 1931, managing approximately $2 trillion. And as you know, we're very proud to say our partnership manager for our PPS Global Equity Fund as well. So with us today, we have Marine, Richard, and Philip, and they'll be focusing on the technology sector, which I'm sure we all are watching carefully as we've seen the sector explode this year. So we have made sure to allocate enough time after the presentation to address questions you might have. So please feel free to add your questions to the Q&A box, and I'll be sure to address them to the Capital team. So now, without any further ado, I'll hand over to Marine. Marine?
Thank you very much for the introduction, Rizik. Good morning, everyone, and thank you for joining us today. I'm Marine Crest, and I'm a relationship manager at Capital Group, and we're absolutely delighted to be invited by our partner, PPS Investment, to present to you all this morning. So let me start by briefly introducing the team, and Rizik already made a couple of introductions. So today I'm joined by two of my colleagues, Richard Carlisle, who is an investment director, and who some of you will remember from the series of conferences we did with PPS in South Africa in February, and also the webinar we hosted in June. And Phil Ray, who is an investment specialist at Capital, and who has done a lot of work on the technology sector, which we are discussing today. So the three of us are based in London, and when we are in the office, which seems a distant memory these days, we're actually sitting not very far from each other. But today we're making this webinar from our respective homes, but I hope we'll manage to run it like if we were all in the same meeting room. So the tech sector is a sector we're often asked about, as it is home to many of the most disruptive, transformative, and fast-growing companies in the world. And it's really driving change in many ways in all the different sectors. And global pandemic has really reinforced and accelerated this trend. So we will share insights on these points this morning. We have about 1 hour together, and we will aim to present in 30 minutes to then allow plenty of time for your questions at the end. So in terms of running order, so I thought I would start with a brief introduction to Capital Group to give you a sense of who we are as an organization. And then Richard will share some remarks on the history of the tech sector before handing over to Phil. And finally, Richard will talk us through the current positioning for the PPS Global Equity Fund and the exposure to the tech sector. So Capital Group, who we are as an organization, there is a lot I could tell you about Capital Group, and I actually feel quite privileged to work for such a great organization whose aim is to improve people's life through successful investing. We are a global active investment manager, and there are a few key points that really differentiate us from other global investment managers. The first one is we grew organically since 1931 without any mergers or acquisitions. And today we manage about $2 trillion across equity, fixed income, and multi-asset portfolios on behalf of our clients globally. This means that we're really the largest active investment manager in the world. And I think what is important about our size is that it really gives us a strong financial stability and also an unparalleled access to the companies we invest in. The second important point about us is we're truly aligned with our clients' interests and with your interest. First and foremost, we are employee-owned. It means that we're very stable as an organization and that we have the ability to focus on long-term investing, which I think is truly a luxury in the investment management industry these days. I just mentioned long-term, and it's really important to us and reflected at various levels of our organizations, not only in how we manage our portfolios, which tend to have a very low turnover, but also how we manage the overall business and also compensate our investment professionals. They are compensated on their long-term returns with an 8-year, 5-year, 3-year, and 1-year component. And we believe this is really aligned with our clients' investment objectives. So if there is really one thing I'd like to leave with you today about Capital, is that we're genuinely passionate about investments, and we focus on what we think we do well on behalf of our clients, which is really research and security selection. This is the essence of our business. I'll pause here and hand over to Richard. I would obviously be very happy to answer any questions you have on Capital Group during the Q&A at the end of our presentation. Over to you, Richard.
Thank you very much, Maureen, and thank you to everyone for joining. And it's nice to be back virtually with you today. So I'm going to talk to page 4 of the presentation deck. If you look at page 4, it just talks about how the technology sector has moved since the global financial crisis. So the first thing to say is that MSCI ACWI, excuse all our acronyms, that's the sort of global share index, including emerging markets. Since the financial crisis, that's returned nearly 10% per annum. Compound that up over since the financial crisis, and that basically has trebled your money, that cumulative 288%. So a very impressive return. However, if you dive into the technology sector, the global technology sector has returned 10% per annum more than the global universe just of all the companies. So that's 7.5 times your money over that period. If you look at the US technology sector, so the S&P 500 technology sector, that's done even better still. And you've basically made 10 times your money since the financial crisis. And if you narrow that down one step further to the FANG sector, and we are using the definition Facebook, Amazon, Apple, Netflix, and Alphabet as our FANGs, everyone uses a different definition, that's returned an astonishing 32% per annum, and you have made over 25 times your money since the financial crisis. So a very narrow sector of companies have turned in astonishing performances since the financial crisis. On the right-hand side, we show you what that's done to the list of 10 largest companies by market capitalization. So the value of the 10 largest companies in the world. Back at the end of the financial crisis, it was dominated by, you can see, oil companies, consumer products companies, telecoms companies, etc. And some of these were very old established companies. If you think that Exxon, which was made from the merger of Standard Oil was founded in 1870, so 150 years ago. J&J in that list was founded in 1886. So these were old, very established companies. And look at the list now, dominated by Apple. Apple is larger than the entire UK stock market on its own. Embarrassing for us British people that we can be smaller than one US company. And some of the others are very recent companies. Note that Facebook was started in Mark Zuckerberg's college dormitory just in January 2004. It wasn't even a company then. It was started in January 2004. Tencent was founded in 1998 and Alibaba in 1999. So the speed with which these new internet companies have grown to be large and dominant companies is truly astonishing. So to talk about them in more detail, I'm going to hand over to my colleague Phil Ray. I had planned to introduce Phil as my younger tech-savvy colleague, but his inability to make his video camera work today slightly undermines that. But I promise you, he is normally tech-savvy, and he's going to take you through the rest of the presentation, I think voice only, and then we'll come back together to try and answer questions at the end. So Phil, over to you.
Thanks very much, Richard, and good morning, everyone on the call. I hope you can hear me okay, and sorry I couldn't be with you on video. As is typical, some tech issues, which is somewhat ironic given the content of the presentation today. But we'll do it over the phone by voice, which will hopefully serve just as well. So just adding to what Richard said there, I mean the complexion of the markets changed substantially in just over a decade, and I think it really says a lot about how the global economy and global trade patterns have changed so much in a fairly short space of time. After this decade of incredibly strong returns and a dramatic rise for many of these technology companies, many in the market are talking about whether we're in the midst of the next tech bubble, or at the very least, how much longer can technology companies and the FANG stocks continue to outpace the market. So it seems like a good point to turn our attention to valuations on slide 5 here. And when we look back over the last 25 years, the current environment looks very different to the dot-com bubble in 2000. And so the dark blue line here shows the MSCI World Information Technology Sector PE ratio, or forward PE ratio, compared to the market, with the 25-year average and the dark blue dotted line. And as you can see, valuations got to extreme levels in 1999. And eventually the bubble burst, and tech's earnings, which are the light blue line, completely collapsed in the early 2000s and really didn't recover for several years. And investors got completely wiped out and lost a lot of money, and it was a pretty sobering experience for technology investors across the dot-com period. Now, you fast forward to today, and what's really driving share prices in the tech sector is earnings. So really, since around 2007 or so, these companies have continued to be incredibly profitable and display very strong growth. And you can see that on the chart, the light blue line there, showing how earnings have really grown quite strongly over the last decade relative to the market. And so, valuations have largely moved in sync with profits, and it's only very recently that the tech sector has moved above this 25-year average forward PE multiple relative to the market, and now trades at about 1.3 or 1.4 times the market. So, yes, the PE multiple has crept up for the sector, but it's absolutely nowhere near the levels we saw in the dot-com bubble. And then if you think about an example of a company like Microsoft, which is a bellwether for the sector, during the dot-com bubble, it traded at about 60 to 70 times forward earnings. And if you'd bought Microsoft stock at that peak valuation when the bubble did burst, it did take 15 years to make your money back. So, clearly the point here is getting valuations right in the sector is an incredibly important part of making money and investing in technology stocks. But you look at today, and the forward PE multiple of Microsoft is about 35 times earnings, and it's a much bigger and better business than it was back in the early 2000s. It's a much more diversified business. It has this fast-growing, high-margin cloud business. It's moved to a subscription-based model, and the company's really generating recurring revenues and much higher free cash flow. So it's a much more attractive investment than it was back in the early 2000s. But the takeaway here is, really the current environment doesn't appear to be anywhere near bubble territory, and valuations for the sector are only really modestly above their long-term averages on a relative basis. And it's really driven by the trend in earnings that we've seen this really strong growth over the last decade. And in particular, this year, we've seen a real acceleration in earnings in the tech sector. So, turning over to, think about, this year, which has been an extraordinary year for so many reasons, but the global pandemic and the policy responses of governments around the world have really impacted different sectors and industries in very, very different ways. So you think about how much travel, leisure, and hospitality industries have really suffered, and you contrast that with how well technology companies are doing. I've got a friend who founded an online sort of recipe delivery kit called Mindful Chef. Now, I promise I'm not getting any commission here for the plug, but I spoke to him earlier this year, and he was telling me that it took 3 years for them to get the subscribers and revenues to where they were at the start of this year, and just 3 months for them to double that again. And for him and his company, the biggest challenge this year is to be able to keep up with the demand they're seeing. And it's a very similar story for many of these large established technology companies. And on slide 6 here, you can see 4 key holdings in the PPS Global Equity Fund, and these companies have really benefited in a massive way from the work from home and shelter-in-place policies that governments have enforced. So, again, just taking Microsoft as an example in the top left chart here, it's been a real winner in this environment across multiple segments, from cloud services or its software services, but also gaming. And the chart here shows their Teams application, it's a workspace collaboration tool that helps people collaborate online and remotely, and it's seen a massive surge in users over the past few months due to everyone having to work remotely. And then look at PayPal on the top right. I mean, again, similar story. PayPal facilitates fast, secure digital payments over the internet, but it's been a huge beneficiary of the fact people haven't been able to go to stores, and they've having to be doing all the shopping online through e-commerce. And then likewise, Shopify, which is now the world's second largest e-commerce platform behind Amazon, it's seen a massive increase in the goods traded over their e-commerce platform this year. So, while many brick and mortar retail stores are really struggling or even going out of business, the companies like PayPal and Shopify have really been seeing their businesses booming. And then Netflix, it's one of the biggest winners during lockdown. Not only are they, able to create great original content like Tiger King, which is a great show. If you haven't seen it, I recommend it. Go watch it. Netflix also produces a lot of really fantastic award-winning content, and they've seen a huge surge in new subscribers, which you can see in the sorts of the magenta-colored line on the bottom left-hand chart there. And they've seen a massive surge in subscribers as more people are spending more time at home and are hungry for entertainment. And I mean, I for one have watched a lot more Netflix. I feel like I've almost completed all of Netflix, and I'm sort of waiting week to week for the next show to come out. And I think the point here is really summed up very well by something the Shopify founder and CEO said in a recent earnings call, that we're really experiencing 2030 10 years early. Now, a lot of the trends that I've just mentioned, these structural trends were well underway before the virus struck, but really in this environment they've been rapidly accelerated. And I think the key question is, what are they going to revert to? And this is really where Capital's investment group are spending a lot of time, analysing and thinking about. And I think while we might expect some sort of reversion towards something normal, the slowdown that might happen would be to a significantly higher base rate than would have been the case without the virus. So, if I give you an example, I mean, the Zoom conferencing app has been sort of the poster child of this work from home environment, and its customer base has grown around about 500% in the remote working environment. And are we going to go back to face-to-face meetings? Absolutely yes. But the world's now much more comfortable with doing them by video as well. So we're not going to go back to the pre-crisis way of doing things. And just another one is, I myself and my household now use an app called Ocado, which is an online grocery delivery app in the UK. There's no way we're going to go back to the old way of getting in a car, going to the supermarket, spending our time walking around the aisles to fill the trolley, when all of that can be just, all that hassle can be avoided for a small fee and have someone bring it to your door. So I think once things do begin to settle towards whatever the new normal looks like, not only it's not going to look like before the pandemic, and really we've seen a permanent shift in some behaviors. And then the other key point here is that while tech's gained a real tailwind in 2020, it's about more than just technology. And Microsoft, on this slide, 6 years, really the only technology company. PayPal's a fintech, Netflix an entertainment company, and Shopify, really enable entrepreneurs to start up online businesses. So it's about companies going increasingly digital across all areas of the economy. And so just to move on, how are we thinking about investing in technology at Capital? And that's what I want to get onto. But I also want to quickly introduce a couple of concepts that help sort of explain our investment thinking around technology. So on slide 8, if you look at index classifications, what we tend to find is they really obscure more than they reveal anything about the nature of technology. And in that sense, sometimes indices can be somewhat unhelpful. So on the left-hand side here, you take the MSCI All Country World Index, which is a proxy for global equities. And the technology sector is made up of around about 330 or so companies, which represent about 22% of the overall global equity market. But consider the fact that Alphabet, which is better known for its search engine, Google, it's probably one of the most advanced companies in the world, and has leading technology in areas like AI and autonomous vehicles. It no longer sits in the IT sector and sits under communication services. So on the right-hand side, what we do is expand the investment universe to sort of better capture the tech opportunities outside the information technology sector. So adding in communication services where entertainment, media, and gaming live, and the likes of Netflix and Facebook, and then also bringing in internet retail where all the large established e-commerce platforms are classified, and you begin to move towards a bigger technology opportunity set with around about 550 companies, and that's about 36% of the overall global equity market. But still, at Capital, we would say this doesn't really help describe how we invest in the technology opportunities that exist in the market today. And this is one of the reasons why we pay very little attention to indices. They're really just backward-looking yardsticks, and they're not something that tell you anything about the future. we can't cover technology without talking about the FANG stocks in more detail. As Richard mentioned, they've risen to become some of the largest companies in the world, and these technology and internet giants, are a constant feature of the media, and with such dominance does come a huge amount of attention. But these are really a very special 5 companies, and they're not just simply tech firms. I would say they're more than that. Sometimes the media uses the phrase that the big tech firms, but I think that really fails to grasp why these companies have been so successful. Really these companies have leveraged technology to essentially reimagine and disrupt entire industries. So, you take advertising, the old days of advertising, was run by, people like, Don Draper from the US hit TV show Mad Men, men in double-breasted suits with drinking scotch for breakfast in, corner offices. Now, the advertising industry is really run by highly sophisticated algorithms that target individuals based on their behaviors, mostly on Facebook. And with over 3 billion users across their platforms, Facebook has a lot of people they can target. And they've really used this monopoly position in social media to disrupt the entire advertising industry. Then, consider Apple. Apple's best known for the iPhone, which was launched in 2007, and I think it's fair to say really changed the world. And when we look back, the iPhone will be looked back at in the same way that the first computer, the first television, or the first radio. And you could describe Apple as a consumer staple company. You think about how long you can go without checking your iPhone. Not very long, I bet. And I'd also say you could describe Apple as a luxury brand. They charge a hefty premium compared to their competitors for their products. So they have, Volkswagen's volumes at sort of Ferrari's margins, which is, great economics. And, Apple have an installed base of over 1.5 billion iPhone users, and they are, wedded to the Apple ecosystem. So it creates an enormous amount of economic value for the company. And I think that's really reflected in the fact it's, hit a 2 trillion market cap earlier this year. And then Amazon, come to dominate the retail landscape in such a massive way. And how have they done that? They provide more choice. They lower prices, and they're able to deliver your products to your door in less than 24 hours. And essentially, they've removed almost all of the frictions of shopping and completely transformed the retail landscape in the process. When we look at, last year they delivered over 7 billion packages. I feel like I, was at least about 10% of that. But what's, really frightening is that e-commerce still only accounts for about 16% of, worldwide retail sales. And that number continues to creep up every year. And then consider Netflix. We used to watch all of our television through cable and satellite, and Netflix used to be focused on online mail order DVDs and compete with the likes of Blockbuster. Blockbuster's out of business now, and Netflix dominates the streaming video market, which has been rapidly taking share in recent years from the incumbent cable and satellite guys. What's more is they've been doing this on a global basis. They've now got 193 million paid members in 190 countries around the world. So it's an incredibly global business. And then finally, there's Google. I think calling Google the new economy yellow pages is somewhat a disservice, given all the amazing services Google deliver. Google's main business is the search market, and they dominate 90% of that market, which has enabled them to become the biggest advertiser in the world by revenues. How have they done this is through the fact that 5.8 or more than 5.8 billion searches are carried out on Google every day. It's where the world goes for their information, and really, in the process, they've created value in so many different areas and have delivered an incredibly diverse array of services. The point here being, I think, from this slide is that these special tech companies are more than just tech companies, and they've, as I mentioned, they've leveraged technology and the internet at incredible scale and with great effect. And in the process, they've not just dominated global stock markets, but they've also become such a huge part of our day-to-day lives. So I think calling these companies just information technology companies somewhat understates the the size of their business models and the true impact they've had on global stock markets. And then finally on 10 here, another really, on slide 10, another really interesting company held in the PPS Global Equity Fund is Naspers, which I'm sure everyone on this webinar is very familiar with. But how do you classify Naspers' diverse set of internet businesses? They're best known for the early and substantial stake they have in Tencent. That Tencent being China's largest social media and gaming company, and that's of course been an absolutely fantastic investment for Naspers. But the company also owns a diverse number of stakes and other distinct internet assets. The likes of food delivery, digital payments, e-commerce, and online classifieds. So again, this is a company that's really diversified by internet businesses and also by the industries it's got exposure to. And I think what's also interesting is Naspers, just how geographically diverse Naspers is. So about 2/3 of the revenues come from Asia, and that's in part thanks to Tencent, with about 20% coming from Africa and 10% coming from Europe. So it's an incredibly multinational company, Naspers. And this has got the hallmarks of the characteristics of the types of companies we look for in the New Perspective portfolio. It's an investment in the PPS Global Equity Fund, but it's a multinational company. It's well diversified, not just by region, but diverse end markets, the services it delivers, and also Naspers has strong exposure to a number of secular growth trends like e-commerce, gaming, and social media. So again, Naspers is another example of how these internet and technology businesses just don't fit neatly into categories. These companies are not limited by the geographic exposure or limited to individual industries or sectors. So let me just recap there. So technology has been a very attractive area to have invested in over the last decade or so. But it's not just about the information technology sector. And really, when we broaden the universe to include those other internet companies and digital businesses, let's call that Tech Plus, there's a diverse and really attractive opportunities from a number of areas of the market. And these companies, particularly the digital businesses, have been huge beneficiaries in this year in 2020 as the response governments have taken to the virus has meant we're all more reliant on these companies and the services they provide than we ever have been. And then when we look at valuations, they've not reached extreme levels and they're not at particularly stretched levels. It's profits that have really driven the attractive returns the sector has generated over the last decade or so. And what we also see is that these types of technology companies tend to be very multinational in nature. They tend to be very well diversified. They have a number of different products and services, and so they don't fit neatly into categories, and they're really not bound by geography or classifications. And so now what I want to turn our attention to is just casting that net even wider, and at Capital we're seeing a lot of really interesting opportunities to invest in technology companies even beyond those areas that we've covered so far. So if on slide 12, I think brings us to one of the most disruptive and possibly controversial companies in the portfolio today. And in fact, Tesla is now one of the largest, or is now the largest holding in the portfolio, having seen the share price rise about 400% this year. It's another great example of a company that has exploited technology to completely disrupt an entire industry, and that industry is, of course, the auto industry. And Tesla have really been leading the way in electric vehicles for a number of years now, and other auto companies are really having to play catch up. And what makes Tesla very special is more than just the car. It's about the entire vehicle architecture. So you look at from the fact that they've signed a partnership with Glencore to mine their own cobalt through to the over-the-air software upgrades that they can deliver after cars have been bought and are on the roads. Tesla has built a number of durable advantages that are much more than just first mover advantages. So think about their vertical integration, from how they source these raw materials for batteries right the way through to how they sell directly to consumers over the internet and also directly through their the showrooms they own. You also think about the integration of their software and hardware. Their drive chain technology is just far better than competitors at converting energy to driving range. The battery cell management technology and the software is all integrated and has just led to some really distinct competitive advantages. All the software is in a Tesla car is Tesla's own, and in general, it's much better integrated into the hardware. And this enables the over-the-air software upgrades that improve the car's functionality over time. That's very different to current cars, which tend to get worse over time. And then you think about all the advanced hardware that's just fitted as standard. High-resolution cameras and sensors. These are the devices that connect the car to Tesla's cloud, and that will enable the autopilot features today, but also the self-driving capabilities that Tesla is touting for the future. And as I mentioned, these cars are connected to the cloud, which is essentially Tesla's fleets of cars' brain. And then Tesla cars record billions of miles of self-driving data, and that's been recorded and analyzed by Tesla, which improves their AI algorithms that can better improve their self-driving technology. And then the upgrades are sent over the air to the software, which is a really powerful network effect, improving Tesla's fleet of cars over time. And these are really durable advantages that have been created by Elon Musk and Tesla. And they've done this by combining the best and most advanced technologies around. Those technologies already existed, but they've taken them and brought them together in combination in a completely new way to transform the established auto industry. And I think a recent quote from the Volkswagen CEO in Davos was, he said, "Tesla has a product that describes the future of the auto industry, a fully connected electric car." So even the competition that Tesla are competing with, the incumbents, recognize Tesla's leadership in the future of the auto industry. And a similar example on slide 13 here, another technology company that's operating in an entirely different field is Intuitive Surgical. Now, the company makes robotic equipment used in minimally invasive surgeries. So let me just quickly explain exactly what the company does and why it's so unique. So the human hands are no longer the best tools for surgery, and in fact, thanks to technology advances in advanced robotics, precision engineering, the advanced camera technology, Intuitive's Da Vinci robot enables surgeons to carry out procedures in fields like urology and gynecology with far less impact on patients, far less incisions. And this leads to faster recovery times and just generally better outcomes for patients. And these robots are really impressive pieces of kit, really advanced and sophisticated technology. And on YouTube you can go and see a video that's now about 6 years old, and you can see one of these Da Vinci robots stitching a grape back together. I mean, it's pretty remarkable technology, and bear in mind that was one of the older models of the Da Vinci system about 6 or so years ago. It's pretty amazing, but why it matters from an investment standpoint is, increasingly these robots are going to be used in more surgeries, which you can see in the chart on the bottom left there. They're seeing growth and adoption across a range of different surgeries. And Intuitive Surgical is the market leader with first mover advantage. But what's particularly attractive about their business is their revenues come from their installed base, and this leads to a lot of their revenues being recurring revenues, about 70% or so. That comes from areas like servicing the Da Vinci robots and maintenance, new tools and precision instruments that they come out with. So a really attractive recurring revenue model that Intuitive Surgical has. I think is another really great example in the PPS Global Equity portfolio of a technology company really changing the in healthcare, but also disrupting surgeries. So it's leading to really attractive growth for a company like Intuitive Surgical. And then the final examples I just want to bring in are on page 14. Another area that technology is having a huge impact is in the development of telecommunications. And specifically 5G networks have begun to be rolled out across the world, and this is a massive step up in upgrades to current networks by more than just speed, and it's actually going to enable really a new generation of use cases and applications over the coming decades as networks are upgraded across a number of different dimensions beyond speed, things like lower latency, greater reliability, and more efficiency. And today, there's a number of different really attractive investment opportunities that 5G are bringing about, particularly when we look at largely in the infrastructure providers. And in PPS Global Equity Fund, we hold a number of companies across these key areas. So one real estate holding we have is American Tower, which is a leading provider of tower sites to the telecoms industry. They essentially lease the real estate that telecom companies use to house all of their 5G equipment, the antennas, and the hardware that's just needed to make networks operate. Now, these are very long-term leases, and they provide really attractive and growing cash flows. And then you look at in semiconductors, two of the largest portfolio holdings are TSMC, which is the world's leading semiconductor foundry, and ASML, the Dutch lithography equipment manufacturer. That lithography equipment is used by nearly all chip makers around the world to produce advanced computer chips. It's seeing huge growth in its end markets. And then also in the portfolio we hold companies that are part of the smartphone supply chain, the likes of Broadcom and Advanced Micro Devices. These companies supply all the critical processors and components, the necessary inputs that go into all of the smartphones we take for granted today. And then finally, data storage companies. So another key real estate holding in the portfolio is Equinix, and it's a global leader in data centers. Effectively, Equinix has become the landlord to the likes of Amazon Web Services and Netflix. And these data centers are based all around the world, and essentially what they do is bring the servers of these companies like Amazon and Netflix closer to end users and help digital companies scale and connect to their end customers. And these are just a few examples of key holdings in the portfolio that sit in diverse sectors from semiconductors to real estate that are really providing the critical technology for 5G's development and potential applications. So I hope what I've said really gives you a good sense of why technology has become such a major part of our day-to-day lives, and also why it's become such an important driver of global equity markets. I also that technology has become much more pervasive and impacts all corners of the market. And so at Capital, we're seeing really attractive opportunities to invest in a diverse range of companies, and not all of them are found in the information technology sector. And that's why, as active managers of the PPS Global Equity Fund, our research is able to uncover investment opportunities wherever they are, regardless of geography, regardless of where companies are based, and regardless of what sectors or industries companies are in. And so with that, let me just hand back to Richard, who's just going to take you through the PPS Global Equity portfolio and then the positioning of the portfolio in a bit more detail. So thanks for listening, and over to you, Richard.
Thank you, Phil, and that was great, even though we couldn't see you. So thank you for that. I'm just going to do a couple of slides and then hand back to Marine and Razik. So on slide 16, this is an update of the slide we've shown you before. It's the top 20 holdings of the PPS Global Equity Fund. Number one observation is that Tesla, through share price appreciation, not because we've bought more shares, has become our largest holding. You can see that we originally bought Tesla in July 2014, so we've owned it for just over 6 years. It's held by one of the managers, so congratulations to that manager. And as I say, through share price appreciation, it's become our biggest holding. Remember, if you adjust for the recent stock split, a year ago the shares were $40, and now they're around $440. So a truly astonishing performance. Happy to answer questions on this. We may well get questions, but I just add to what Phil said. Phil talked about the technology. I mean, in a financing sense, that's surge in the share price has allowed them to do two very substantial fundraisings. So when we talked about Tesla a year ago, many people says to us, well, it's going to run out of money at some point. Well, they've solved that problem now with those two fundraisings, and in fact, they could easily accelerate their expansion if they have the financing to do that. So that's one point. You will also notice further down the list, I think fourth from the bottom is Shopify. Phil said, I think, now astonishingly Canada's largest company, again owned by one manager, not the same manager who owns Tesla, incidentally. That is our most recent addition to the top 20. You can see it was bought in January of this year, so before the benefit of lockdown, and that's been an astonishingly good return in a very short period as well. Globally and in the US in particular, stock markets are becoming more concentrated, and that's reflected in that the total for our top 20 holdings is now just over 40%. I think when Maureen and I came to South Africa at the start of the year, that number was more like 33, 34%. So we have, along with stock markets, had a more concentrated portfolio. But I would point out that the total portfolio has approaching 300 companies. We have this characteristic of, we allow managers to choose their high conviction ideas. When managers agree that an idea is high conviction, so 6 of our managers owning Amazon, for example, they tend to be the biggest holdings. So on the one hand, it's diverse, but on the other hand, where we have high conviction, they can be a very big holding. So that is the top 20. Happy to I'll give to Phil the difficult questions on any of those companies. If you just look at the next page, this is slide 17. This is a slightly different way of looking at our holdings. So just to explain this slide, on the right-hand side of every sector, you see the 3 largest companies in that relevant sector. So the 3 largest information technology companies are Apple, Microsoft, and Visa. And on the left-hand side, we show our 3 largest holdings in that sector. So our 3 largest technology holdings are Microsoft, TSMC, and MasterCard. We actually have a very small holding of Apple, not only in this fund, but in many capital funds. We're not significant Apple shareholders. If you look, so in some sectors, we do own some of the biggest companies, but in other sectors, we don't. If you look at healthcare, for example, the 3 biggest companies are J&J, that long, established in 1886 company. It's United Health and Roche, the Swiss drug company. But our holdings are Intuitive Surgical. Phil talked about their Da Vinci robot, Thermo Fisher Holdings, and Vertex Pharmaceuticals. So really rather different from the benchmark there. And even right down at the bottom, just worth highlighting energy. I mean, we are cautious on energy, which has worked well recently, but rather than owning Exxon, Chevron, and Royal Dutch, which are the 3 biggest companies in the universe, we own Reliance Industries, which is Indian and probably more driven by its telecoms exposure than its energy exposure, Rosneft and Schlumberger. So really rather different from the benchmark. So I will pause there. There is a key takeaway page on the next slide, but I hope you agree that just really summarizes what we have said so far. So I will pause there, hand back to Maureen and Razik, who will take us hopefully into questions, which we'll try our best to answer.
Brilliant. Thank you, Richard. Well, maybe just before we take it to a Q&A, I'd like to tell everyone a bit more about the New Perspective strategy, which is really the underlying strategy behind the PPS Global Equity Fund. So as you may recall from our previous conversations, New Perspective is really a global equity strategy that we have been managing since 1973. So it really has an established track record. And the objective of this strategy is to achieve long-term growth of capital by investing in companies located around the world that can benefit from the changing pattern of global trade, which is an important aspect of this objective. And importantly, as you will have picked up from Richard and Phil's presentation, New Perspective and the PPS Global Equity Fund is not a technology, internet, or digital platform growth type fund. It is really a core and flexible global equity strategy, which will not be trapped into any particular style, geography, and sector, and which can easily adapt to its environment. As an example, year to date, 9 out of the 11 sectors positively contributed to excess return. So in short, a time-tested approach with over 47-year track record, with strong and consistent returns, and also a history of downside protection. So I'll pause here, and I think Razik will take us through the Q&A.
Thanks so much, Marine. If we can maybe touch on one of the first questions. I see we've had a few questions that was sent through along with that we received on the RSVPs from the audience. I think one of those in particular. So firstly, to Ravi, yes, we will definitely make these slides available, and there'll be a recording footage. So don't worry, we'll make sure you have those. I see the first question I have listed here is, do you foresee the tech antitrust investigation in the US having a material impact on the technology sector?
So I'll start and give Phil a chance to think of a better answer. But I think yes, any companies dominating their industry, antitrust becomes an issue. I think there are several things to say there. First of all, there is a growing history of how large tech companies cope with antitrust issues. For old people like me who remember that when Microsoft dominated the personal computer software space, they imposed Internet Explorer as your default web browser. They resisted for years attempts by other web browser producers to get their browsers onto computers. The US government effectively enforced that at some point, and Microsoft relented. I think all tech companies have learned, therefore, that resisting antitrust pressure is ultimately futile. You have to go along with the direction of governments. You know, our analysts on these tech companies, though, have spent a lot of time both talking to management about how they feel about antitrust issues, etc. And I think we have said to you in the past, if you look at, say, Amazon, you know, Amazon is the well-known home shopping business, but it's also this enormous and fabulous Amazon Web Services business. There is no real need for them to be in the same company. If they were demerged, actually, our analyst thinks that is value enhancing. If you're an Amazon shareholder, you could get two components that have a greater value than the sum of the parts at the moment. Facebook is probably the one facing the most difficult antitrust environment. You know, how this US election goes for Facebook will be quite important in that. But Facebook is the one you would worry about most as having antitrust vulnerabilities. Some of them, though, I mean, we just don't see any issue. I mean, Amazon provides a arguably better service at a lower price than competing high street retailing. We struggle to see, how there is an antitrust issue there, and they also choose not to make any profits in their home shopping business. So that we struggle to see any sort of antitrust downside on the home shopping part. There are small technical issues about Amazon possibly using the data of third-party retailers to promote their own products, but they are immaterial in the grand scheme of things on Amazon. Phil, what have I missed?
Well, no, I'd largely just echo what you said, but these companies display sort of natural monopolistic characteristics, and that tends to be quite hard for antitrust regulators to actually regulate. We've seen some of the most sort of stringent regulations coming out of Europe, and when you look at what it's done to their businesses in this region, it's really not had a material impact. So, I think we recognize the antitrust and the regulations and the pressures are rising, particularly as we go into this election cycle. But so far there hasn't been any real material changes to these businesses, and they have this natural monopoly, and like Richard says, the nature of the companies tend to add value to their end consumers, which is typically not where what antitrust centers around. Normally it's through things like trying to extract prices, higher prices from consumers, and that's just not been the case with these companies. So yeah, I think that Richard summarized it very well.
Excellent. Thanks so much, both to Richard and to Philip. I see we have a few more questions. Just one that I'd like to just quickly answer from Mark Morris, who asks if this is an SA offshore feeder fund as well as a discretionary fund available on offshore platforms. Mark, the answer is yes on both accounts. So the feeder fund is available on our platform at PPS Investments, And then we do have the dollar-based fund as well available on offshore platforms. So please make a point of speaking to your investment specialist or make contact with us, and we will help you access it. So the next question that I have here is from Francois de Toy. He asks, is sustainable investing or ESG a consideration in stock selecting for inclusion in the PPS Global Equity portfolio?
Well, absolutely. PPS Global Equity, or New Perspective in capital terms, is not an ESG fund. It doesn't have a list of exclusions that we don't invest in. So we believe that engagement is a better tool than exclusion. But I think if you think of us as large, I mean, we are the world's largest active equity manager, long-term investors, we are very well placed to engage with companies. You know, we have unparalleled access to company managements around the world. And we also have a time frame. Remember from previous webinars, we pay our managers on their rolling 8-year returns. We think that's the longest in the industry. And, you know, that is the right sort of time frame to consider when you're having engagements with companies. So it is fully integrated. It's not an ESG fund as such, but, you know, if you name any of those top holdings of ours, or even the 300 of the entire holdings, we have engagement with management. We do it behind the scenes. The last thing a capital person will do will be to go onto Bloomberg TV or CNN and discuss our meetings with companies. We think we're much more effective doing that behind the scenes, but we engage with all companies, and, you know, we urge them to sort of improve practices, etc. One of the growing demands from clients is to see carbon footprints, and we are going to start to show in all our New Perspective and PPS Global Equity presentations the carbon footprint of portfolios. And the New Perspective fund versus its benchmark has roughly a carbon footprint half the size of the universe. So our lack of exposure to those oil companies, you know, coal mining companies, etc., and our overexposure to companies like Amazon, which actually, if you think one Amazon delivery van replaces 20 people driving to a supermarket in a day, you know, they actually have quite a positive impact on carbon emissions. So it's not an ESG fund, but it's very much taken into account.
Thanks, Richard. Maybe just to add a small point to this, I mean, and very much to echo Richard's point, I mean, as a long-term active fundamental manager, I mean, our investment professionals really have to consider the ESG considerations alongside other financial and business metrics when thinking about long-term investment ideas. So it's the only way we can really make sure we are considering the potential of an investment idea over the long term again.
Thanks so much, Marina and Richard. I see another question we have here is, as all these companies are global, please share some feedback on the diverse revenue streams from a currency point of view, seeing that you do not hedge for currency exposure.
And Phil again will chip in, but you know, so the question is right. We are simply bottom-up stock pickers. You know, when it comes to currency, the number one objective for us is understanding the currency impacts on the companies we invest in. Are they buying raw materials in one currency, selling it in another currency? Where are their borrowings? Are they hedged, etc.? So we really must understand the fundamentals of how currencies impact companies. And we don't currency hedge largely. I mean, there has in the history of New Perspective been very modest hedging of yen exposure back to base currency of dollars, but we don't do currency hedging simply because we don't think we add any value doing it. We are stock pickers. Having said all that, I hope in previous presentations you've picked up on we call it the new geography of investing. And, you know, in South Africa, this is going to be straightforward to you. You have Naspers as a South African listed company. In reality, the majority of its revenue is China related. So, you know, if you have a split of a portfolio saying, oh, we have a lot of South Africa exposure, our view of that is, you know, you've got a lot of Chinese exposure. So that is a key fact. And we do report both on our holdings by domicile and by revenue. And we think the revenue exposure is much more important and going to become even more important in the future, as you say, as our portfolio is multinational. One of the interesting things is that if you look at our exposure by domicile, while. We have very modest exposure to emerging markets. When you look at it by revenue, it's well over 20% of the total portfolio. So that's a good example of how, you know, domicile is just less and less relevant. Feel free to add.
I think you covered everything there, Rich.
Thanks so much, Richard. Another one from Jean-Pierre. Thoughts on blockchain companies?
Well, I
defer to Phil. Blockchain is a yeah.
So I mean, blockchain is still a very nascent technology, and the underlying the primary use we've seen so far has been in things like Bitcoin and in currency, and as we know, they've been incredibly volatile. Some people have made an incredible amount of money. Some people have lost an incredible amount of money. The underlying technology behind blockchain is a very interesting technology. This sort of idea of the sort of building consensus and not having centralized ownership of managing the technology. And so there's a lot of different applications that have potential to use this technology, and it could be quite transformative. But over the long term, as with any early technology, it's just sort of it tends to be fairly experimental in the early stages, and as a result, investing in that area tends to carry a lot of risk. You look at our portfolio in New Perspective. We're focused on emerging and established multinational companies. And in particular, you don't really see any of those, as blockchain specific businesses. What we do see is, some established companies experimenting with the technology and looking to see if there's ways that it can improve their, processes. Like JP Morgan, for example, is experimenting with blockchain technology to look at their, back office systems and whether they can better automate trade settlements and things like that. So, our analysts are familiar with the technology. There's a lot of research written in our database about blockchain technology, and also through the engagement that Richard's mentioned with company management. There are conversations happening about new technologies like blockchain and how they're being implemented at some of these companies, or at least experimented with. So it's something we're looking at, but I'd say it's a very early technology, and it's going to take time to see how it can really play out and actually add economic value to companies.
Thanks so much, Phil. Perhaps on that, maybe you can share how you guys are using technology or AI to actually improve your own research capability and process.
Yeah, sure. So I guess I can start, Richard, and then see. So I mean, we have made Capital spends a lot of money on technology and is making some pretty substantial investments, and we've hired some pretty impressive people from the likes of Amazon, who are leading efforts for us to implement things like machine learning processes into our research process, or at least having that technology available to our analysts who may want to use it. There's also been a huge number of investments around different systems that are really enhancing capabilities, and one springs to mind, a system called AlphaSense that we're using that is able to sort of use artificial intelligence and really scan through things like earnings reports and financial statements, and you can use that tool to build more robust models, and also to help discover emerging trends. So there's a number of different ways that Capital is really making big investments into these areas, and then exploring ways that can help enhance our investment process. So that's what I'd probably say high level. I think it's something that all companies are having to sort of grasp. But technology, as I mentioned, is having transformative impacts across all sectors and industries. And like any other business, we're looking to keep ourselves at the sort of forefront of these value-enhancing technologies that are out there today. So I'll leave it there and see if Richard has anything to add.
No, nothing to add. Well put.
Thanks so much, guys. You can't have a global manager on the line like this and not actually talk about the US election. So I would love to hear potentially views on Biden versus Trump, and also the outlook you think should either of the two win? And perhaps if Biden does win, how do you see the US-China relationship shaping up?
Okay, so here we really quote our US political analyst, a guy called Matt Miller, which and if any of you have listened to Capital webinars, you know he's a very interesting speaker. I mean, he has just, I mean, he's sort of, you know, first of all, the opinion polls tend to undersell Trump voting. It seems that many people, when asked an opinion poll who they're going to vote for, don't say Donald Trump, but then end up voting for Donald Trump. But even aiming off for that, I think Matt Miller thinks, you know, Biden is now looking the favorite. I don't think our investment process is dominated by whether we think Biden or Trump is going to win, but we do a lot of work around the scenario that we would see for various industries on a Trump win or a Biden win. On China in particular, I think we think they're both pulling in the same direction. We think that President Trump has pulled harder in the anti-China direction, but I don't think a Biden president would change the direction. He may pull less hard, but, you know, long term, China is a significant threat to the US's economic dominance. It's growing faster, and it's got a sort of a younger economy. So you know, China and the US are going to have a bumpy relationship for the future. The big issue that means is really around the tech sector and the tech supply chain. Bear in mind, as Phil mentioned, you know, what that 110 million installed base of iPhones, they are largely manufactured in China. Any interruption to that would be very painful to Apple, and also painful for Apple suppliers. So that's one of the things we watch. But you know, I guess it's looking like Biden's going to win, but don't think if Trump wins that upsets our investment process or anything like that. We analyze the likely scenario under both outcomes.
Excellent, thanks so much. I see we've actually reached our quota of time that we have available. Before we actually wrap up or anything, I'd just like to maybe open the floor to yourself, to Philip and Marine, for any potential closing comments to the audience before I wrap up.
Thank you, Razik. Well, just thank you for inviting us to present this morning, and thank you for all your questions. We're here to help, so let us know if there is any follow-up questions or reactions on this presentation.
Thanks, Marine. Richard or Philip, anything from your guys' side as well? Any closing comments you'd like to make?
Yeah, likewise,
thank you for your patience listening to...
Sorry.
Go, Phil.
Oh, sorry, I was just saying likewise. I just say thank you very much for listening, and apologies I couldn't get the video working, and you know, it'd be great to meet you, you know, once hopefully once we, you know, revert back to the so-called new normal.
No, thanks for listening, and the fact that Phil couldn't make his video work has cheered me up enormously as a dinosaur. So thanks all for listening. So.
Thank you, everyone.
Thanks so much, guys. And once again, thanks to Marine, Richard, and to Phil for sharing such valuable insights with us today. I know I always appreciate these chats with him. I'd just like to say thanks to everyone who's taken the time to join us today. As I mentioned, Ravi, we will definitely be sharing a video, the recording of the session with you guys, and probably in the next few days to come. So on that note, I'd like to just say thank you again for attending, and good luck out there, guys. And please stay safe. Remember, we are still in lockdown. Thanks so much from PPS Investments. Goodbye.